Hi, Michael Glennon from Glennon Capital. Today I'm going to talk to you about growth. So growth is one of the things that we look for, so we want to have companies that are growing. Now growth is a very broad term, so I'm going to endeavour to explain some of the things that we like to see. We may not see all of them, but we like to see businesses that are growing, and what that means is that either their revenue's growing or that they're operating in an industry that is growing, that's getting bigger. It's not into terminal decline. It's like horseshoes, they're not really growing anymore, but many years ago it was a growth industry. Or that they're gaining market share within the industry that they're in because they've got some technological advantage, or they're a small player that's got a cost advantage. Or finally that the company might be entering into a new market where they can grow into that market. So there's some of the types of growth that we can get, and some of the ways that companies can achieve that growth is that they can get, they may get margin growth, which might mean either increasing their prices so that for every unit they sell they're making more money, or alternatively they may sell the same number of units but be able to cut their costs, which means they're also increasing their margin. Or finally they might be able to increase the volume that they're selling. So if you think about if you've got a store and you're paying $100,000 rent, and you sell $100,000 worth of product out of that store, you're not going to make any money. But if you sell $200,000, you'll make $100,000, and if you sell $300,000, you'll make an extra $200,000. So that's one of the things we like to see, but also the other thing that we need that growth to translate into is earnings per share growth. So if it's costing the company a lot of money to actually get that growth, it won't flow through into earnings per share growth. So we like to see that the growth flows through into earnings per share growth. And to sort of illustrate that example, if a company's got a million shares on issue and it's making 10 cents per share, if they issue another 100,000 shares, then that $1 million of profit is actually going to reduce by 10%. So the growth doesn't come through into earnings per share. And ultimately, we also like to see that the free cash flow per share increases, because that's the most important measure to make sure that the share price is going to increase, is that the earnings per share is increasing and the cash flow per share, so the real cash generated by everyday activities, is increasing. So that's growth. That's some of the different types of growth that we look for. All of those characteristics may be present, or maybe only one or two of them. And if that's enough for us to be able to see that there's going to be a change in the business and that there might be some value there because the market hasn't fully modeled the company and doesn't understand the cost structures or the potential of new markets or changing technology that might increase revenue and lead to growth, there's some of the advantages that we've got when we're looking at companies and doing quite detailed analysis, being able to ascertain that there is growth coming through into the business. So thanks for watching. I hope you're a little bit more enlightened about growth and the importance to growth and small company investing. And if you've got any questions, please feel free to email us or ask us a question in the comments below. Thank you.